All right, stocks got a little bit of an ugly start, especially in the NASDAQ 100 because of the earnings from Google and Microsoft. But they had two kind of saviors, so to speak. They came in and saved the day for them. And that was a falling dollar and rising bonds. Or falling bond yields, I guess would be another way of saying that. So falling yields, falling dollar has been the case the last few days. Came in and pushed us up to new highs, but then we came back down and closed at the lows. So I'm going to break down why, like what's the significance of that? What's the technical environment like right now? And have we broken out? Like, have we been bullish enough to finally do it, or have we just, is there a reason why we butt our heads up here at this level? So I'm going to show you some of those levels, show you some of those charts, I'll tell you what to expect, tell you another time here in the recent history that we've seen a very similar pattern. What happened then and why, and how would that look like now? So I'm going to break that down. I'm going to show you the moves in the dollar and bonds, talk about the potential of how much further down can bond yields go and why. So I'm going to break that down, and then our trade idea as a stock that we might be able to take advantage of this run that we've had if it ends up being more of a false type run. We'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, October the 26th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get started, I invite you to subscribe to our YouTube channel with this icon or the subscribe button down below the video. Click the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, you can check out some of these other things, the Market Outlook live videos, well, those other classes. Come down here to the right, click on that heart. It opens up this tab, click that like button. Same thing with the thumbs up icon. It pulls up another tab, hit that like button. Again, we did break way, like we got well back, easily above 100 likes here. So I really appreciate that. We had been well below it the last few Market Outlook videos. So these go a long way for us, as well as the super thanks here on YouTube. It might be in this little menu right there, but as you can see, super thanks is a way to express gratitude and show support for these videos that we put out for you all day in and day out. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we finished the day with a long upper shadow. So we opened and closed pretty much right at the same level, despite rallying early in the day, coming off of those Microsoft and Google earnings, and then dropping to the lows of the day by the time we were done. Not just on the Qs, but obviously here on the S&P too. Did not stop the intermediate line from crossing into the upper half of the chart. You see the intermediate line has not only crossed above the market sentiment line out of bearish territory, but is down the upper half of the chart. That's what gives it dark green shading here. We are more than 2.5%, just barely, but we are more than 2.5% above the 30-day moving average, which makes it likely that as long as we stay here and ideally extend away from it, we can turn this yellow line higher. The yellow line, it's yellow because we're above it, but it's still falling, right? So if it were above it when rising, you'd be green, which is the bullish trend, and obviously the yellow is kind of a transitionary period between trends, and so that's the possibility. This is potentially a transitionary period between trends, especially if this intermediate line were to get up here above 60. If it doesn't, and ends up coming back down, the near-term line comes back out of bullish territory again without staying up here for very long, and the intermediate line avoids getting up there, then we have another situation similar to what we had back here, right, where we had a good strong near-term line. I got the intermediate line eventually all the way up above 50, and then we turned down pretty sharply. I don't think we'll turn down sharply again this way, but we ended up with dark green shading there and a yellow line, and that's kind of what we got now. We were at some resistance at that point. At that level, it was for this market sentiment decline. You can see we were at the 38% Fibonacci level there. We ended up holding that and come back down. As of right now, we are at the 23% retracement, just a little bit above it actually, but sitting just a smidgen above it. at the 23%, as well as all these other levels that we're currently at right now too. So the S&P is like, it's not good. I mean, these few days have been great. These 3 days have been great. I've shown you that they've been great. If you follow me on Twitter, I posted quite a bit about it yesterday. But following up with this kind of a candle, not so good. And we'll see tomorrow if we end up, with this negative meta report coming after hours, which so far hasn't impacted the market. But if, the whole idea of 3 of the main FANG stocks dropping, as well as the other 2 that are currently dropping into their earnings announcements, it ultimately impacts the broader markets in a negative way. Let's take a look at the NASDAQ 100. You can see it had a bigger long upper shadow, is not 2.5%, only less than 1% above. The intermediate line is out of bearish territory above market sentiment, but still in the lower half of the chart with the near term dropping. So, and you can see the resistance it's holding is here at that 38% retracement of this current intermediate run that it's on. And the 50%, see this is the level that we're hitting up against right now, these 2 lines. And that 38% retracement line is way up here, and we're nowhere near the 23% level you can see at the brown line. So these lines are currently we're kind of sitting right at those lines on the S&P, even if we're well below it on the NASDAQ, excuse me. The Dow is a different story. The Dow's been a lot more bullish, as you can see on the current intermediate rally. We actually did get up all the way to the 62% retracement and the 38 of the long-term market sentiment decline, and long upper shadows so far have held that level. Now its intermediate line, you notice, is in bullish territory. Even if we're and we are well above, like we are easily in the upper percentiles of how far above the 30-day moving average we are right off the bat. See, over here we got up this high at the end of this, what ultimately was the end of the run, but easily, a month into dark green shading and green line, we're up at that level, and we have just started the dark green shading and the green line, because of kind of an interesting pattern there. Not quite the nice overbought cluster that you like to get when you're very starting. That kind of like a breadth thrust kind of a signal, kind of solidifies the bullishness you get strong enough to change the trend, which is what you need when you've been on the bearish trend. So not quite getting that here, and like I said, maybe a little bit too extended in a short amount of time, according to what we're seeing down there. Let's take a look at the Russell. It's kind of in between, a little bit less bullish than the Dow, more bullish than the NASDAQ. Did get, sitting at that 38% of the green, which is the current intermediate drop. Not able to get above the 23% of the long term. Remember, the Dow is up to the 38%. That level, and up to the 62% of the current intermediate decline. The S&P is sitting right down in here. So, it's kind of in the middle, but again, it's intermediate line above its market sentiment, out of bearish territory, but, not in the upper half, not in bullish territory yet. None of these, except for the Dow, are in bullish territory. And just some really, really long upper shadows, which are bearish. When you've had a bullish run, they can be bearish. So, really important day tomorrow, because the way you confirm these single day patterns is by closing below them, right? And you can see from a whole perspective, from a Hakinyashi perspective, we did get a higher close on the Russell. So to confirm that long upper shadow, we have to get a lower close, which we already have gotten on the NASDAQ, right? The NASDAQ did get a lower close. So to confirm that, we'd have to close below that body. And then the S&P was slightly higher. Again, we'd have to get a lower close to confirm that long upper shadow, that body. You can see, the Hakinyashi candles have been relatively bullish, and they're down below their moving average there, and that sets up for weakness. Doesn't mean we have to have it, but it starts to set up for, getting smaller bodies sets you up for a lower close, right? That's you generally you can see when you fall below these moving averages, when you start to get the reversal. Same thing here, and same thing over here. We got the reversal as we started getting smaller bodies. So we already have the reversal from a relatively high level too. The purple line here at where's that 70? Where would it be at? 77. So if I were to change this number to 77, kind of where that purple line is at right now. And let's just kind of smooth it out, make it a little smaller so we can see it. Okay, so there's where that purple line is currently. You can see, this is one of the higher levels. This is that the average has gotten to. So, falling below those levels, you can see in the past has been reversal, except for here when you were on a bullish trend at the time and you continue to be higher. So it'll be interesting to see how this plays out, whether it plays out more like these last two or the continue when we were in the middle of a bullish trend and you had, the MACD up here was rising, was positive, and not the MACD, the PPO was positive, and over here you can see it's still negative, similar to these other two times. All right, so let's take a look now at the other weekly chart. Over here you can see this is about as bullish as you can be. You got a green arrow, you got a bullish candle, you got a rising PPO. Those all three things is about as bullish as you can possibly be on this chart. A very, very good sign. Of course, the Dow is even more bullish. We'd actually got the same signals last week on the Dow, and it's confirming that this week. Very, very strong Hakinyashi candle. One of the bigger ones we've gotten all year. In fact, the biggest candle we've gotten all year. Biggest bullish candle we've gotten all year on the Dow Jones Industrial Average. On a weekly basis, the week's not over. Not on the S&P, not the case on the S&P. The NASDAQ 100, not the case either, right? Not even close to as big of the candles we got there. And you notice no green arrow yet. Relatively bullish candle. It's bullet in the rising PPO. Your Russell 2000 is getting that this week. Green arrow, bullish candle. Again, not nearly as bullish as what we saw earlier. So the Dow is really kind of the outlier in terms of the bullish performance here. Let's take a look at 3 green arrows chart. 3 green arrows across the board. Pretty decent volume, if you recall, on some of these. But for the S&P, holding resistance at the 50-day moving average. So we filled in the gap between the 30 and the 50 because we crossed above the 17, rising MACD. We have now filled in the gap between, we crossed above the 30, you fill in the gap. Remember when I told you when there's big gaps, you tend to fill in the gaps. It's when you break above multiple is when the trend changes. The MACD is our histogram is pretty darn high, higher than it's been all year, right? This is, you can follow my cursor here. In fact, let's do this. Let's go to 1.12889. So let's do 1.12889. Let's just make it smaller so it doesn't cover up the chart. So again, you can see the couple of the times we got this bullish over here and right here. And again, there's a lot of comparisons of this period. In this case, we didn't quite touch the 50, but we got above in between the 30 and 50 when there was a relatively sizable gap between all of these coming off of a low level, where instead of converging for a while, we just went straight up, and that appears to be what's going on right now with the histogram that's as high as it was then, as high as it's been all year, and as of today, rolling over so far at that resistance level. Look at the DMI. We are below 20 on the negative indicator. We are just stubbornly not above 25 yet on the positive, which again throws into question just how positive we are of that Harami pattern there. Not only the long upper shadow, but also the Harami. You look at the RSI and the CCI, not getting above 60. We are above 150, but we're not getting that combination of being above 150 and being above 60. Again, we had that here. Over here, we were above 150, not above 60. Over here, we were not above 150. We were above 60, but not above 150. And so both of these failed. This one, we actually did get above both of them, but that was about as close as we got. We broke through trend lines. I mean, that was one of the biggest fake outs we've seen, and you can see how bearish we've been since because of it. This one, kind of going back to these two peaks, where we had, over here, we didn't have either one of them. Over here, we were slightly above 60, but this was the beginning of the year, right? That was actually the ultimate peak. But these two were the failures, and this one, as of right now, is kind of looking pretty similar when you're not getting both of these working in your favor. Of course, the Ichimoku cloud is still trendless. We're still below the cloud. You can see the rate of change for the 26-day period, which needs to turn positive. So this red line right here, this red line is a graphical version of this chart. The rate of change over 26 days, which you can see is still positive or negative. Obviously, getting positive helps change the trend, which means when you're looking at this chart that the red line crosses above price, which it will pretty much do unless you really drop relatively sharply, at least at the same pace that we dropped over here in late September coming out of expiration. Are we going to have that same kind of drop coming out of this expiration? So that's the question, and that's what would keep the rate of change negative, and it would also get us, keep us below the cloud and keep us back below these lines without a bullish trend starting. That's the important move to watch tomorrow. As of right now, again, you avoided getting above the upper band and the upper Keltner channel. The bands are still inside the Keltner channels. You can see the bands are still, inside the Keltner channel. So we're not closing above either one of them. It's kind of hard to really set a new trend when you can't close above either one of them, if not ideally both of them, when you're starting the trend. So far we're not getting that. Could tomorrow, but again, you wouldn't expect. You can see the stochastics is still in, above 80, so we still like the Arun indicator still positive. So there's still opportunity to be bullish here, but again, long upper shadow with low volumes and low ranges at resistance is not a good sign, right? There's your low range, and of course the lower volumes. I didn't show you here, but you can see on this chart. Going into today, we did end up with 104 million, 6.23 points. That puts you, a little bit above average here, but the average is, still falling. And then of course 6 points is down in here. I did want to show you volatility. Volatility dropped today. It's still relatively high. It's, we finally kind of broke through a level here, getting to 27 and down here. But here's the kicker. The VVIX is dropped like a rock. I mean, this is one of the lowest levels of the VVIX that you've seen, right? When you go to, when you look at, again, the VIX being 95% correlated to the VVIX, and you look at this chart and you see, dang, it is really, really low. Like, again, one of the stronger bearish moves that we've seen in the VVIX. Again, one of the strongest. It was only, early June. Again, that was that mid peak there in June. Very similar to what we're getting now on SPX. This is the peak I'm talking about right here. This mid-June peak lines up with the last time the VVIX was this bearish in this amount of time. They got the PPO this low, which measures the gap between its 8 and 17-day averages. So, I mean, we've really dropped sharply, and for the VVIX again to be at 80. Again, the last time the VVIX was at 80 or at this level was here, July 29th. To give you an idea of where the VIX was on July 29th, the VIX was right there. It was at 21, and right now we're at 27. And when you look at it on this chart, on July 29th, right here, we were below 90%, and right now we're at 96%. So it's still in bullish territory for volatility, and when you're above 95%, it's bullish. When you're below for volatility and below 90, you're bearish. So we were on July 29th, right there, below 90, barely, but below 90, and really, really low here. And you can see it took a while before it rallied up. But again, the last time that the VVIX dropped as much as it did was right here in mid-June, and we had right here, and we were right around 24, and the VIX hit this low. You wonder if the VIX is going to hit a low here and jump up from a much higher level this time than it's jumped up on any of these other lows, which again suggests that we might be getting forthcoming, a pretty dramatic, probably one of the bigger jumps in the VIX that we've seen. You can see its ratio here, had the ranges here. Well, here probably would be better to look at it on this just to kind of get an idea of just how low the ranges are. Like the VIX has been so low. You can see this is one of the smaller ranges we've had. I mean, you'd have to go all the way back to some of these levels where the VIX was a lot lower. And over here, it was kind of, this is post-COVID, but it was kind of at the same level, and we spiked, right? And this is when you're this low in the VIX. When this jumps to the upside, there's only one way it jumps. The VIX spikes, right? It starts the jump to the upside and then works its way down, upside and works its way down. I mean, it doesn't spike to the downside. It spikes to the upside and then works its way down as the bandwidth comes down. So if this is going to spike to the upside, if the VVIX is going to spike to the upside, which you expect that it would because that's what it does, right? After being so bearish, if the VVIX spikes to the upside and the bandwidth spikes to the upside and the VIX spikes to the upside from 27 instead of 20 or 21 or 19, then you can kind of get an idea of what might happen and how bearish we might actually be here. Again, not that I think we're going to fall off a cliff, because I don't think we're actually going to have a Lehman moment. But I do think we'll probably make our way back towards the 200-week moving average, if not below it. Remember, we're easily above it. And, again, it's kind of hard to be in a bear market when you're above the average price of the last 4 years. Say that out loud to yourself in the mirror and then tell yourself that's a bear market, right? When you're 6% above the average price of the S&P for the last 4 years, which is 36.12. 36.12 is the average price for the last 4 years, and we're at 38.30. So it's kind of hard to be in a bear market when you're, again, above the average price of the last 4 years for the S&P 500. So it kind of puts in the context just how really bearish we are. Again, it's just because, consider over here, and if you were to go back to January the 3rd, when we were peaking, we were at 4,800, and the average price at the time was around 3,300. So we were at 4,800, and the average price was 3,300 for the last 4 years. So that's really bullish when you say that, right? Because that's 45%. You can see it's at 40, or almost 40, a little bit more than 40% above that price. So that's really bullish. So to correct something that's really bullish isn't a bear market. To get below the average price of the last 4 years and stay there is a bear market. That's a big difference, as you can obviously see now. So it's a little bit more nuanced than just picking a random number and deciding that's what a bear market is. So we're 6%. So I think we're, again, with this jump in the VIX, I expect it will be coming. I don't think it will tank us, but I do think it will get us back to and through that 200-week moving average, so below 36.12, and to at least this 33.80 area, this pre-COVID peak, if not a little bit lower, towards these Fibonacci levels is where you might find some support on the S&P. If we take a look at what's driving the action today, interestingly enough, was a falling dollar, right? That was the biggest move, the dollar coming off of its peak. Got a lot of people really bullish initially, but then you notice with earnings, the Qs drop, but you notice that IWM did bullish. IWM was really bullish at the beginning of the day, way outpacing the S&P, again, because of those Google, Microsoft stocks that really weighed on the Qs and that weighed on the broader market as a whole. Eventually, the IWM came down. Was only up about 0.5%, underperforming gold on the day with a strong move in the dollar. The Qs obviously down more than 2%, bringing the S&P down almost 0.75%, real estate flat. Long-term bonds were up, so yields were down, the dollar was down. Those are two things that presumably are relatively bullish for the markets. That's what's driving, if you notice here, if you look at the dollar index here, dropping below the 50-day moving average, opportunity to really start to fall. This is one of the most bearish times the dollar's been all year. It's easily in the 10th percentile. And the other times we were this bearish, we were a little bit below the 50 there, but for the most part, we held the 50 on all these other times. We'll see if we end up holding here. We are at the 23% retracement. So once we break this level, 29.5, then we'll start to retrace this big long-term move we've been on. That longer-term rally we've been on here, the brown line, you notice we haven't broken that 23 yet. That would be below the 17-week moving average, and we would be starting a more bearish move there. But keep in mind what this means. Of course, it also coincides with some bullishness in bonds. Bonds are having its best week in a while, right? Trying to figure out this really low PPO here and trying to get going to the upside above the 8-day moving average for the first time in a long time. All the way back over here was the last time we were pretty easily above it, significantly above it in September 21st. Obviously way in the bottom of the value area, long ways to go, very little volume, so we can really move, but keep in mind what that means. Like TNX is at 4% right now. I mean, that's where the 3-month yield is. 3-month yield doesn't go down unless the Fed's not going to raise rates. The Fed's got a 97% probability they're going to raise rates to 450 basis points by the December 14th, 15th. So that's a 75 basis point hike now to get to 400 basis points, and a 50 basis point hike in December to get to 450. So the 3-month yield doesn't drop unless the Fed starts cutting rates. And right now it's at 4%. The 3-month yield is at 4%, and because that's where the expectations are for the Fed funds rate to be next week. Was it next week? Yeah, next Wednesday, a week from yesterday, a week from today. So it's not like it's how, I mean, if the 10-year yield is finally inverted, it's actually inverted with the 3-month yield. You can see it's inverted 5 basis points. It's obviously already 40 basis points inverted on the 2-year. So, I mean, the 2-year isn't going to be dropping very much. It's close to the terminal rate of where the Fed will get to. The 3-month is kind of where it's kind of pricing in that 75 basis point hike now. It generally gets to those rate hikes as we approach those levels. And then, so for the 10-year to drop, it would create an even bigger, I mean, it's rare for the 3-month to be inverted at all. Even just a few basis points, it's just rare. It generally, that prompts the Fed to start cutting rates. And so that's, we're already there. The 10-year is at, it's been around 50 basis points. That's a big spread. That's a big inversion. It's been bigger, but it's a big inversion already. So for it to get, for the 10-year to drop, that would make what's already a really big inversion on the 10-2-year be even bigger, right? If I were to go to the yield curve here, this one. Here we go. So I've got the maximum available. There's 0%. You can see we got all the way down to here to 50 basis points. There's the inversion before the 08-09 bear market. Did not even get close to 50 basis points. There's the inversion before the 2000 bear market. It did. And then there's our inversion in 89 that prompted this kind of semi-recession that we had. And then it goes back to 81, 82. We had, well, let's see here. Yeah, 81, 82, we were about 50 basis points. So 50 basis, and then obviously in the 70s and 80s. But 50 basis points is a pretty large inversion. So for the 10-year to drop even more, which means bonds rallying, right? Bonds rallying would mean the 10-year drops even more, below 4%, would create a bigger inversion than what we've ever seen on the 3-month already. It's already inverted. It would create it's already a big inversion on the 10-year, and this would make it even big. So in other words, the limit to the downside for the 10-year yield is we're there. There's not much more downside for the 10-year yield without the Fed cutting rates, bringing the 3-month down and bringing the 2-year down. And the Fed's not signaling that at all. In fact, it's the opposite. Anytime you've heard Powell speak, he has alluded to Volcker, not Burns. Every time somebody else has been speaking, they've been beating the same drum, banging the same drum that Burns admittedly made a mistake with, that he admittedly made the mistake with in the mid-70s, that Powell referenced in his Jackson Hole speech. So unless the Fed comes about face from what they said in Jackson speech, completely 180, and then says, we know it's a mistake, but we're going to do it anyway, because they've already said it would be a mistake. He said in Jackson Hole, it would be a mistake to start to pull back too early. So, I mean, if they're already going to be pulling back in December, that's pretty much going to be too early, especially with the real Fed funds rate that's still the lowest it would be ever, if not for the, going into this year. That's even though it's off of its lows right now. So it's not even positive yet, much less strongly positive, which is what they are looking to get it to. This would be pulling back early, and they've said publicly that there was a mistake to pull back early in the 70s. Even the Fed chairman at the time said that. That's why Volcker, who was listening to Burns admit that mistake in public, said, okay, then we're going to raise rates, and he did. Right? That was that tweet that I shared with you, that thread from the Wall Street Journal Fed mouthpiece. So in other words, there's not much downside to 10-year yield, which means there's not much upside to bonds right now. I don't think there's much downside to bonds either, because I don't think there's much upside left here. I think the Fed's pretty much going to be stopping at 4.5%, 5%, at least here pretty soon. But again, the bullish narrative is based off of bonds rising. And the other bullish narrative is based off the dollar falling, which is great. Dollar's falling, right? We got potentially, this is the worst short-term sentiment we've seen since back over here. We're way below the 30-day moving average, 2%, biggest number we've seen all year, right? It's at 0% over here. So, there's a chance that the dollar could start to really falter here, which, obviously some bulls have seen as a positive thing. But the problem with that is it's also really positive for commodities, which defeats the point of being bullish, because the point of being bullish is that commodities were falling and bringing inflation levels down with it. See, this median inflation, the median CPI, which doesn't even include energy, because energy is typically one of the biggest risers early and then fallers now, gets stripped out of the median CPI. So the median CPI took off here in March of 2021 when this took off. In fact, if you notice, when commodities broke above their 200-week moving average, that's when CPI took off. And at the time that happened, you'll notice that inflation expectations took off, right? They were down around 2%, but by March 2021, they started to go up and eventually peaked at 2.4. Well, guess what? That's where we're at now. We're at right around 2.4. We dropped a little bit here today, but inflation levels are still, expectations levels are still high. With a falling dollar, that's not going to help it, because this is going to get commodities, which are now crossing above the MACD, stochastics rising out of bearish territory. The price itself holding the 50-week moving average and jumping back above the 17. If we were to get back above this 23% line and work our way up, then we're not going to get moderating inflation, which is, again, the rising bonds, so falling yields and moderating commodities are going to help keep the inflation, bring the inflation levels down, so the Fed will stop raising rates and we're back to being bullish again. But the yields don't have a whole lot of room to drop, which limits bonds upside. Doesn't mean they have to, right? Yields don't have to necessarily go up a lot. Bonds don't have to drop that much more. They don't have a whole lot of upside. And a falling dollar, which is what everybody wants, would actually be kind of counter to what you want, because it would actually push this higher and defeat that whole narrative. That's the catch-22 we're at right now. That was the catch-22 we had in 2008 too, and in the 70s, where you either had high inflation, which limits stocks, or you had demand destruction, which brought commodities down, and that was recessionary. So you were either in a recession or a rising inflation environment, and that's why we had so many corrections and bear markets between late 60s all the way to the early 80s, because that was the conundrum we were in there, and that's the conundrum we're in again now. It's very rare because we haven't been in an inflationary environment since the early 80s, essentially. It's been a pretty consistent long-term downtrend in yields. And so we're experiencing something that I haven't experienced, a kind of market environment I've never experienced, that no one has experienced since late 70s, early 80s. All right, for our trade the other day, I wanted to take a look at Goldman Sachs, right? One of the big names in the financial sector. They've already gone through their earnings season. Goldman Sachs is showing a strong bullish pattern, 8% above its moving average. Not quite 90th percentile or higher, but pretty close. Dark green shading, green line, market sentiment, intermediate lines above its market sentiment and in bullish territory. So pretty good. I mean, we see some pretty good signs for Goldman Sachs across the board here, above the 40-week moving average as well as the 10-week rising PPO. Looking at the 3 green arrow chart, you can see that we do have 3 green arrows, and we did get pretty decent volume on the 3 green arrow day. Looking at the 2-line versions of this, we are slightly above the 200-day moving average with a pretty strong MACD histogram, the strongest that we've had all year. We've seen this before, so it's not a surprise. And you notice we are right at the point of control, the big volume node. So we got a big resistance level here, just a smidgen above the 200-week moving average. We've had a run above the 200-week moving average, it didn't hold. And so you wonder if this one is going to be able to hold to at the 50, in this case, at the 50 weeks. See, that's where we failed that last time. That's where we're at right now with a big volume node here on the 1-year chart. And you look at the Bollinger Bands, like the S&P, we have not broken out of that upper band yet. We are outside the Keltner channel. We are at the top of the Keltner channel, but we see we got above it over there slightly too, but we never have gotten outside of the band, which is what you need to get if we're starting a trend. You want to get outside of the band. You know, you can see it started here, got outside the Keltner channel too, and then rallied to that false breakout move up here. Here, we haven't done that, right? And then you look at like the Ichimoku cloud. We're not even above the cloud. We're actually in the cloud, at the top of the cloud, which will act as a resistance level. So you can see there's multiple resistance areas here for Goldman Sachs to be able to hold. So let's take a look here. There's one more chance at the DMI. You can see also pretty good move here on the DMI as well. So really bullish indicators, but some resistance levels. So considering the broader market expectations as well, what I decided to do was to do a long put spread. Short, small risk, right, in case resistance breaks, but as we've always said before, we expect resistance to hold until it doesn't. So I didn't quite buy at the money. When I did this in the Market Outlook Live, which remember you just saw a link for when we started this segment in the top right corner of your screen, we put this trade on before the market closed. We didn't buy at the money. We bought one strike price out and then sold for the one after that. So this is what it looks like. Position size around 2/3 or normal position size, a little bit more than normal, going for about $900 of risk, about 3 times what we normally shoot for on $1,000 of risk. So 3 times the normal risk for almost half the normal, or 3 times the normal reward for almost half the normal risk, for a little bit lower probability, but I can keep that risk even smaller if we break resistance here, because we're there, right? It doesn't have to make a big move to break resistance because we're already at the resistance, and we're kind of trading on the expectation that this resistance will hold like it did last time, right? At the 50-week moving average, smidgen above the 200-day at that point of control on the 1-year chart. All right, well, that wraps us up for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, like or join our website at marketscholars.com, and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.